this evening to our entrepreneur education and mentoring series entitled Growing Your Business from the Ground Up. Our program is designed to track the way an entrepreneur should leverage best practices to build a company and grow it from start through liquidity. For those of you who don't know me, my name is Kaufman. I am the chairman of the board of the Long Island Capital Alliance. I'm also a partner and the chairman of the corporate department of Abrams, Fensterman, one of Long Island's largest full-service corporate law firms. Long Island Capital Alliance's mission is to encourage economic development on Long Island by facilitating capital formation, i.e. raising money, for a broad range of companies in various industries, from early stage to mature companies, closely held, middle market companies, and publicly traded businesses. LICA accomplishes this mission primarily through education, networking, quarterly industry-focused capital forums, and alliances with other regional organizations. We are thrilled this evening to be partnered up with the New York Institute of Technology in presenting this first in our series of detailed events. Our kickoff of this series occurred on April 5th at the Day Swirsky Mansion, just a few steps away on campus here. We attracted over 100 entrepreneurs and key business professionals from the Long Island business community. That evening, we provided an overview of the topics that we will cover tonight and in the upcoming remainder of this series. The program this evening, well, let me run through the whole series for you. What we're going to cover over the course of several events are forming a business entity, protecting your intellectual property, hiring and firing key employees and the human resources systems appropriate for early stage businesses, using stock, options, and other equity as compensation to incentivize your employees, designing and implementing appropriate accounting systems, financing alternatives, there are lots of different ways to go on that front, and sales, marketing, and communication strategies. Tonight, we'll focus on the first two topics, forming an entity and protecting your intellectual property. Those are very often the first two things that an entrepreneur starting a business needs to focus on. So we'll deal with them tonight, and then at our next event, we'll deal with additional topics relating to employees, how to hire and fire and manage employees, and how to use equity as compensation for employees. That'll be at our next event. All the dates of the subsequent events in this series are listed on the handout that hopefully you all got at the reception table. Our next one will be October 25th. After that, January 12th, where we'll address accounting systems and cash flow and financing alternatives for startups. And after that, April 6th, designing a business plan for success and the keys to successful communication and marketing. I want to especially thank our sponsors of this series, Alcott HR, Carter DeLuca Farrell and Schmidt, and R&D Tax Savers. We couldn't do this without them, and we thank them with all we have for their participation in this series. As I mentioned earlier, we're very pleased to partner with NYIT's School of Engineering and Computer Sciences on this important initiative. At this time, I would like to introduce to you Dr. Nada Anid, Dean of the School of Engineering and Computer Sciences. She will have a few words to say about NYIT.
Well, thank you, Neil. Last time we hosted you at the Swirsky Mansion. Tonight, you're in the midst of our Entrepreneurship and Technology Innovation Center. My name is Nada Marie Anid, and I'm the Dean of the School of Engineering and Computing Sciences here at NYIT. We're thrilled to be partnering with Leica on this series. And welcome to all of you. I will talk briefly about the center. Of course, it started as a concept to bring together, to bridge the gap between industry and academia. We are an engineering school. We have the talent that you need to execute your projects and develop your products. So coincidentally, the New York State governor started his Open for Business program to boost the economic development on Long Island. So we applied for a grant. We were one of the first schools to obtain, and private institutions to obtain such a technology grant. And that's how we formed this center. We also have funding from the Department of Commerce in DC. Of course, we needed to focus on key tech areas. We looked at a report that showed growth on Long Island in the three main areas of IT and cybersecurity, bio and health. I mean, that's huge on Long Island, and you know from all the IP protection that you work on. And of course, the third one, and it's the smallest sphere, but very important after Sandy, is the clean and tech sector, energy and water. So this is what we're focusing on, and the structure that we have is a collaborative one. Businesses come to us, and we are very flexible. You think IP, you think non-disclosure. We work with our legal team on a case-by-case basis, and we sometimes go to external IP lawyers here on Long Island for assistance. So it's all about forming partnerships, developing products along with you, testing them. We want to be a solution center, a technology solution center and hub for Long Island. We also are, you see this facility, it's a training facility, training for entrepreneurs, professional development, short courses, 3D printing, coding, you name it. Again, these are the various areas. I will stop here because I have 2 more seconds to go.
2 minutes.
Minutes? Okay. So basically, how to get involved? You just email me. I hope my business cards, I'll distribute them to everyone. It's nanid@nyit.edu, and we are always open to ideas and discussions. Of course, we have the interns you need, we have the students, and we have PhDs who are really experts in the 3 fields I mentioned. So we work at 2 levels with established companies and of course with startups. We have the Department of Commerce gave us funding to create a business accelerator. So startups, we have a collaborative shared area where you pay a modest fee for a desk, but you get all the advantages of the entire center. All right.
Thank you very much. That's great, and obviously this is a tremendous facility and likely will be a huge asset to the Long Island business community for years to come. We all know that there's a real shortage of high-quality engineers on Long Island, and what NYIT is doing to address that need is fantastic and critically essential to the growth of our local economy, to which we are also committed. So,
Any more slides?
well, I don't know of a better way to get to
Does
the
it
side.
end? You know how you push them to the
I'm
end?
pausing here, not
I have my whole day.
pausing on a few here for you.
All right.
So, this evening, I'm going to speak for a few minutes about forming an entity and how to pick the right one and what some of the attributes of them are. And then George Rezos, another member of the board of directors of Leica, will address how to protect your intellectual property. So with that,
if I may add, I'm sorry, that to interact, all you have to do is just push here and do all that much.
right, and I will ignore you until it's time for questions and answers. No, that's not true. Happy for interruptions. It'll make it sail along. There will be some time for Q&A, for a few questions maybe when I'm done, and then a few questions when George is done, and then when it's all done, we'll take questions, for the rest of the night, just like ball players sign autographs for the rest of the night. As long as you keep asking questions, we'll keep answering them until at least 7:35. So, if you're starting a business, many people start a business as a sole proprietorship, which is basically just a fancy word for they haven't formed an entity, they're running a business out of their personal checkbook or a wallet or a purse or whatever you want to say. So that has the advantage of not having any startup costs and not having to deal with any corporate formalities, and it's the disadvantage of you're conducting business as an individual person. You have total liability for all of the liabilities of your business, whatever those may be, and you have none of the advantages of having an entity that we'll describe in a few minutes in terms of growing your business. Sometimes businesses will start, instead of by one person as a sole proprietorship, they'll start as a partnership. Two people get together and start a business. In the absence of anything else, that is a general partnership. Again, the partners have unlimited liability for all obligations of the business. And each partner in the general partnership has the authority to bind the business to anything. So if you have a crackpot partner, they can go off and incur millions of dollars of liabilities, and you are personally liable. Now, most people are not really comfortable under those circumstances, for obvious reasons, and hence the birth of limited liability entities, such as a limited partnership, and a corporation, and a limited liability company. For our purposes, we will discuss two types of corporations, one being a regular C Corp, the other being an S Corp, which is, from a corporate standpoint, almost the same as a C Corp, except it gets partnership flow-through tax treatment, which has some advantages. Limited liability companies have the ability to select whether they'd like to be taxed as corporations or as flow-through partnerships. Most of them, the vast majority of them, elect to be treated as partnerships. That's one of the real advantages of that structure. The primary factors in choosing which entity you're going to use for your business is limited liability, as I just discussed, taxation, as I just discussed, and then some of the factors like how to capitalize your business and how to control it. There are different levels of flexibility and alternatives in different types of entities. So as I mentioned, sole proprietorship is the simplest and most common structure right at the very beginning, before you've done anything. If you want to operate under your own name, that's fine. If you choose a business name, you are required to file what we call a fictitious name certificate, and in New York State, that is on a county-by-county basis. So if you're George Rezos and you want to start ABC Business Corp., George is required to file a fictitious name certificate with the county clerk of whatever county he's operating out of in order to operate under that name legally. Again, no distinction between the business and the owner. You have personal responsibility. It's not the greatest way to raise money other than on your own personal credit cards, and it's a one-man band. So if you die, it's over. Now maybe at that point you don't care, but the business is done, and it could also get messy if you have children or the relatives who might want to succeed to your business. Sole proprietorship can make it difficult. So the reasons to form an entity include limited liability. All these entities, partnerships, corporations, limited liability companies, are separate legal entities. They are separate from their owners. The owners are not responsible for the obligations of business. In order to maintain that veil of limited liability, though, you need to avoid what we call piercing the corporate veil. That's how the owners of a business can become liable for the liabilities of the business, even if you form a corporation or an LLC or a limited partnership. You get your corporate veil pierced, and there are some things that we'll talk about to not do if you want to avoid that. With entities, you can establish how the company will be managed and run, how profits are shared. In a corporation, that's usually reflected in the shareholders agreement. In an LLC, it's set forth in its operating agreement, and in a partnership, it's in the general partnership agreement or the limited partnership agreement. Having a corporation, especially, but also an LLC, and in some cases, a limited partnership facilitates raising capital because you can sell economic interests in the business. On some level, a lot of people think, if you're an Inc. or an LLC, it adds credibility to your business as opposed to just using a trade name. So, what do you need to do to maintain your corporate limited liability? And when I say corporate, it refers to LLCs as well. For limited partnerships, it's a little different because essentially their limited partners are not allowed to participate in the management of the business. The general partner manages the business, and any limited partner that participates in the operation of business will lose their limited liability protection. So, for a corporation or an LLC, first thing is to maintain proper corporate records. You can go into a lot of law offices around this state, this country, and you see these beautiful corporate books lining the shelves, often on the top shelf, where no one can reach them. I once went into a law firm, and when I told them I was a corporate lawyer, they said, "Oh, you probably know what we're supposed to be doing with those books up there." Yeah, I almost cried. The reality is, maintaining proper corporate records is one of the key factors that determines whether the limited liability of the stockholders of a corporation will be respected in the event a creditor tries to hold you responsible for the liabilities of the business. You need to maintain minutes or written consents of board meetings and shareholder meetings, have at least annual elections of officers and directors, and maintain separate corporate books. Don't just have one set of books for your own personal life and the company. Like set up a separate QuickBooks file. It's not that hard. It really is critical. Don't commingle the money. That's where people get themselves tripped up all the time. The company's money belongs to the company. Your personal money belongs to you. Once you start, putting the company's payments into your personal account and commingling funds as if there's no distinction, you seriously open yourself up to having your corporate veil pierced. The company needs to have its own separate bank account and use it scrupulously for all of the revenues and obligations of the company. And adequate capitalization. If you form a company and you never capitalize it, it's perennially undercapitalized and ends up screwing its creditors, that's one of the factors that courts will look at in piercing the corporate veil. If you do all those things well, you should be okay, unless you screw this up. And people mess this up all the time. It amazes me. If your company is going to incur an obligation or liability of any type, sign a contract, send a letter making it a commitment. You need to sign it the way it's laid out in this big green box called yes, and not how it's laid out in this big red box called no. Any obligation of a company is incurred on its behalf by its officers, or in the case of an LLC, by its managers or managing members, or sometimes officers. LLCs can also have officers if it's so provided in the operating agreement. The critical thing is it's the company's obligation. Anything to be signed gets signed company name by name title. That makes it crystal clear that you are signing this in your capacity solely as an officer or other representative
of the entity and not as an individual, like in the no box, where you're just signing your name. And even if you write your title and the name of the company underneath, not nearly as good. Many people don't even do that, but not nearly as good. Follow the green yes box. That is very important.
Yeah, how about if it's on the letterhead? Is that, it's on the corporate letterhead?
Even so, so it's on the corporate letterhead, but you sign it, Michael DiStefano.
It's still.
Problem.
Okay.
Problem. You sign it, corporation, by Michael DiStefano, president, no problem. Why would you ever, like, mess with that? It's so easy. Just do it right. That's so many people. So, let's talk about partnerships for a minute. Partnerships have a minimum of 2 owners. If you don't have 2, you don't have a partnership. You have a sole proprietorship. You have at least 2. Like I said earlier, you can have a general partnership. Oftentimes, general partners equally manage the business. Sometimes they don't. They are personally liable for the debts. Now, you can have a general partnership even without a written partnership agreement. Just, George and I agree we're going to start a business together. We're partners, even if nothing is in writing. Now, for a limited partnership, that needs to be in writing. You need to file a certificate of limited partnership with New York State or whatever other state you're going to organize in. And you need to have a limited partnership agreement. There has to be at least 1 general partner. The general partner is required for tax purposes to have some kind of, at least minimum, substantial economic interest in the limited partnership. And like I said earlier, limited partners have no liability for the debts of the business so long as they are not involved in operating the business in any way. Once you cross that line, you lose it. Limited partnerships are also required in New York to publish their existence in 2 newspapers when they are formed. One of the beautiful things about partnerships is flow through taxation. Profits and losses are allocated and distributed among the partners, and the only tax is paid by the partners on their personal tax returns. Whereas in a corporation, if you have a C Corp, and that corporation is running a business and it makes $1 million, the corporation has to pay corporate level income tax on that $1 million. And then after it's done paying, 40% or 45%, whatever, tax it might pay, and there's $550,000 left, then the corporation can distribute that remaining $550,000 out to its stockholders, and then those stockholders pay income tax on those dividends. So it's called double taxation. It's generally not something people like to do, pay more tax than they need to, which is why pass-through taxation vehicles like partnerships and LLCs are very popular. In general, it's best from the IRS's standpoint to allocate profits and losses in proportion to your capital accounts, which is what you contributed to the partnership. Partnerships can depart from that, but you subject yourself to IRS audit. Corporations. As I mentioned earlier, both C Corps and S Corps are corporations. So they have a fundamentally similar corporate structure, but there are some differences. And I think you'll see in the handout that lays out in detail the differences between S Corps, C Corps, and LLCs, which we'll get to in a minute. A lot of the nuances are in there. Some of the key ones are, in a C Corp, you can have any different class of stock you want. Common stock, preferred stock, all different flavors of preferred stock. In an S Corp, you can't. The technical rule is you're only allowed to have 1 class of stock. The exception to that is you're allowed to have voting and non-voting common stock. But that's it. You cannot have preferred stock or any other distinctions between classes of stock in an S Corp if you want to get that passed through partnership taxation treatment. Preferred stock can be a very useful vehicle, which is one of the reasons why C Corps are so popular, even though they're oftentimes not as favorable from a tax standpoint. You can have preferred stock, which is a very common financing vehicle. That can have preferential dividend rates, voting rights, conversion rights, redemption rights, all kinds of features that investors love that make it more palatable to raise money for your company. Corporations are governed by their board of directors. It is actually the board of directors that is responsible for the management of the business and affairs of every corporation. In America, unlike most of the rest of the world, directors are required to be individual people, not entities. In most of the rest of the world, that is not the case. Here it is. Directors are required to act in good faith and with a degree of care which an ordinarily prudent person in a like position would use under similar circumstances. So if you're an expert in something, you're deemed to have brought that expertise to the boardroom. The board of directors are elected by the stockholders, typically annually, but it can be any time. In turn, the board of directors elect the officers, who are the people who actually act on behalf of and have the authority to bind the corporation. People like the president, the CEO, the vice president, the secretary, the treasurer. And the authority of each of these officers is generally established either in the bylaws or as determined by the board of directors, depending on what the bylaws say. To form a corporation in this country is blessedly easy. Again, around the world, it's not so easy. Americans don't understand the concept of forming a corporation in 20 minutes is only in America. You know, in most other countries, it could take days, weeks, sometimes months to form a corporate entity. In America, you fax it out to a service company and gets filed the same day. This country's great. Once you file the certificate of incorporation with the applicable Secretary of State, corporations are governed generally by their bylaws, which are adopted by either their stockholders or their board of directors, or oftentimes by the incorporator who forms the entity, subject to amendment by the stockholders or the board of directors. The bylaws is where the guts of how the corporation is managed is set forth. A corporation is organized by its incorporator. The organizer typically names the initial board of directors in a statement of organizational action, then hands off the company to that board. Be careful. If you go online or you use a really low-level service company, you can name the initial board of directors in the certificate of incorporation, but that's publicly filed with the Secretary of State and is available to anyone who wants to order it. So if you want to maintain confidentiality, do not name the board of directors in the certificate of incorporation. Leave that to the incorporator. Initially, when you form a corporation, the stockholders typically ratify the election of the board of directors. The board of directors elect the officers and accept the initial subscriptions for stock from the stockholders. The stockholders do need to actually subscribe for the stock, pay for the stock at least par value, and the board of directors has to accept that subscription and authorize the issuance of those shares. So in closely held corporations where there's more than one stockholder, there are very often are shareholders agreements among the shareholders, and I'm using those terms interchangeably. Some states use stockholders, some states use shareholder. You know, I'll just use them interchangeably. Those shareholders agreements typically establish the rights and limitations on certain shareholder actions, things like requiring things like supermajority, on voting for certain things, approve certain things, transfer restrictions, so stockholders can't bail out, buy-sell provisions among the stockholders, rights of first refusal, things like that. Similar provisions are found for LLCs in the operating agreement. So there's a fundamental policy in the law in this country that says that any restriction on the transferability of shares is suspect. There's a public policy in favor of the transferability of shares. Notwithstanding that, when people form closely held businesses, you know, like if George and I are going to form a business, we don't want either one of us bailing out on each other. So we will very often agree in a shareholders agreement to transfer restrictions that neither one of us can sell our shares to a third party, for example, without offering it to the other one first, or giving the other one a right of first refusal. Very, very common. Or maybe there are certain things that neither one of us should be able to do on our own, like, you know, borrow $20 million. Well, that will require unanimous consent, or some other kind of supermajority. These things are all found in the shareholders agreement of corporations, and many times they also include what we call drag-along and tag-along rights. So if there's a majority stockholder and a minority stockholder, if the majority stockholder wants to sell out, he'll have the contractual right to drag the minority stockholder along with him By the same token, if the majority stockholder is going to sell out, the minority stockholder will have the right to tag along with them in the sale, so that way nobody gets screwed. Just quickly, the high points of the differences between C Corps and S Corps, again, laid out in much more detail in the handout. C Corps pay double taxation, like I explained earlier. They can have multiple classes of stock, there are no ownership restrictions, and no IRS election is required. An S Corp gets flow-through partnership taxation, no corporate level tax. It can only have one class of stock. It's limited to 100 shareholders maximum. Shareholders are required to be U.S. citizens or residents, single-member LLCs, or qualifying trusts. So you cannot have a non-U.S. resident as a stockholder of an S Corp. You cannot have a C Corp as a stockholder of an S Corp. You cannot have an LLC that has more than one member as a stockholder of an S Corp. And S Corps have to make an election on IRS Form 2553 within 75 days of incorporation to obtain S Corp taxation status. A few words about limited liability companies, and I'll try to wrap it up. Hand it up to George here. LLCs combine the limited liability features of a corporation and the pass-through tax treatment of a partnership or an S Corp. Hence, it's in theory a beautiful thing. You have to file an articles of organization to form it. In New York, you have to publish. In many states, you don't. The operating agreement contains all the relevant provisions about how you run the business, who has what rights and powers. In New York, unlike most other states, a written operating agreement is legally required by statute. LLCs can have any kind of flexible management structure you can dream of. Just, I would advise, don't get too creative because it can be a morass. You can also have any kind of ownership provisions you can dream of. Again, the more creative you get, the more room you have for misinterpretation. So while partnership taxation treatment is one of the great advantages of LLCs, it's also one of the great drawbacks. For you accountants in the room, or God forbid you have any tax lawyers in the room, partnership taxation is, in my experience, the single most complex, difficult, and easy to mangle discipline of the law. It's just so complicated. I sat next to a guy in law school in corporate tax class, and he was clearly the most brilliant guy I ever met in my life. He made partner at Prevailing for 5 years, the only person ever. He took no notes all through corporate tax class. But that's unusual. Most people, it's a lot more difficult than that. And very easy to make mistakes. So for example, if you have a corporation and you hire key employees and you want to grant them stock options, it's a tried and true thing to do. People know how to do that. If you want to do that in an LLC with partnership tax treatment, it is not so simple. You can grant them profit-sharing interests that are kind of sort of like restricted stock or stock options, but not exactly. And it can get very complicated very quickly. LLCs have some other drawbacks. For example, principals have to pay self-employment taxes. Single-member LLCs file taxes like a sole proprietorship on your own Form 1040. And there are some limitations about 401k and pension plan usage in LLCs. So, I find that a C corporation is the preferred structure of investors like venture capitalists, and certainly for public companies, and if you're going to have a real large number of owners. If you're going to start a company, you're going to be on a high growth trajectory, you're going to raise capital and go public, you're going to be a C Corp, and you might as well just bite the bullet. On the other hand, if you're not planning to go public, and you think you're going to have tremendous cash flow, particularly if you're going to have losses during the initial years of operation that you're going to fund out of your own pocket, then an S Corp and an LLC, or even a limited partnership, can be a much more advantageous structure. So that's about all I think we have time to go through this evening. If we have questions, I guess we have a couple minutes for questions, and then I'll turn it over to George. Anybody still awake out there? Yes?
So I'm currently in New York S Corp, professional S Corp, and according to the liability And am I totally protected from liability? Other people told me that if there's professional liability, I may still be liable for it.
Well, that's true, and that's why you have insurance. Yeah, you're still gonna be liable for a professional malpractice, and depending on the profession, it's gonna have different standards of liability that you'll be subject to.
Okay, and one other question
Sure.
related to that. Like I said, I'm currently an S Corp, but let's say at some point in time, I get this great product, and I want to become a C Corp. Is it just as easy as saying to the IRS, I'm a C Corp now?
S Corp to C Corp is very easy. C Corp to S Corp, very hard.
Okay.
Right, Mike?
Oh, is that difficult? I don't think about that one.
With accumulated earnings and all that?
Yes, there's
It can be
issues.
messy. I've seen it be messy.
It
at
could be
times.
messy, but it's not that bad. Going from a corp.
It
to an
depends on
LLC
what your history
Going
is.
from a corp to an LLC is really, don't want to do that.
You don't want to do it, right?
No, because there's taxation there.
Okay, thanks.
But yeah, there is some issues with.
Wouldn't it be the same going to an LLC or an S Corp?
No, because you pay tax on the fair market value of the property. You treat it as distributing it out of the corporation at fair market value. It's treated as a sale.
But why would it be different going to an LLC versus, oh, this because it's the same entity, and you're just making an election. But you can't go from C Corp to S Corp, except within the first 75 days of your existence.
No, you can go from a C Corp, you convert, but then, yeah, if you have accumulated profits that you haven't distributed out and haven't paid dividends on, that gets put on the side. You will pay that
You
eventually.
don't have to pay tax on that.
And if there's been appreciation in the property, that theoretically, let's say you have $1 million of appreciation. If you sell the business within, or sell that asset within so many years, I forget what it is, you don't have to pay tax on it.
Captured, right? It can be complicated. You need to speak to your accountant or the tax.
Well, that's why I won't go C to S.
I'm sorry?
S to C.
Yeah, you won't go, you're right, you probably won't go from C to S. Well, going from S to C is easy. People do it all the time, they just screw up their S Corp eligibility. Yes.
The company that I have is currently an S Corp, and we're in the process of raising some capital from some angels who are arm's length investors. They want preference, and so my assumption has been, in order to provide that, first of all, their initial round of financing is going to be as a convertible note. But there will become a time when we raise additional money, at which point it's a trigger for converting to a preferred share. At which point, then I assume we have to lose our S election and convert to a C Corp.
Depending on how that's structured, you might lose your S Corp election right away, because no investor in their right mind would buy a convertible note that converts into a preferred stock that does not yet exist. And if I represented that investor, I would insist that you amend your certificate of incorporation to create that class of preferred stock into which the note would convert, so that if I want to convert, I don't have to first wait for you to file your certificate of amendment to add that class of preferred stock. Once you create that class of preferred stock, your S Corp election is done. You're secret.
The certificate of incorporation gives you the authority to create the stock. It doesn't necessarily create the stock.
If you have the authority to create blank check preferred stock in your certificate of incorporation, you will not need an S Corp. So why don't we, if there are any further questions, we can hold them for the end, and we bring up my colleague, George Licarezos from Carter DeLuca. He will address intellectual property.